All right, everyone, welcome to the 2026 Stanford Professionals in Real Estate Key Trends in Real Estate Strategies Outlook webinar. We're kind of building on the what we did last year, where Emmy and I discussed the outlook. We thought it'd be maybe a good idea to make this a fixture of the year as people are kind of looking ahead into their strategies and what lies ahead for the year. So the format that we're going to kind of try to repeat is to have me and Emmy, both members of SPIRE and SREC, and both heads of research at real estate investment management firms, but also invite someone from another firm, maybe from outside the Stanford community, to join each year and participate in that forward-looking view. As a reminder, SPIRE was founded in 2009 as the alumni community recognized the opportunity to connect alums, students, faculty, and staff in the kind of area of real estate built environment. We have more than 3,000 community members of alumni, all those groups, alum, students, et cetera. And while it's an official alumni club of Stanford, it's also an independent nonprofit entity, and there's a lot of great things that SPIRE is doing, and it's been a kind of a driving force of uniting real estate and built environment related industry and work at Stanford. So Emmy is the managing director and co-head of global investment research at Heitman. Greg Kane, the non-Stanford participant, is the head of European research at PGIM, and also has had a hand in shaping their global outlook. And I'm the global head of research and strategy at LaSalle Investment Management. So, following a volatile 2025, we're going to talk about the outlook for 26, sentiment, capital flows, where valuations are headed, strategy. The format for this is we're going to have each of us present a few slides, a few highlights from our firm's outlook, followed by a debate on a couple of key topics, and then a rapid fire round where we kind of look at our views on, compare our views on a couple of sectors, and then we'll come to audience Q&A, at which point Tricia Peterson will help moderate that Q&A because it comes in fast and furious. And if you have Q&A, there should be a Q&A box available to you, and Tricia will see that and help moderate that. So with that, we're gonna look at the outlook slides from each of us. I'm going to share the slides on my screen and turn it over to Emmy, who's gonna kind of bring those highlights from the Heitman view. Emmy, over to you.
Okay, thanks, Brian. Hi, everyone. I'll dig into some of the highlights of our 2026 outlook at Heitman, and I'm going to focus my comments mostly on the U.S. since Greg and Brian are going to be speaking a bit more globally, and I know many of you are pretty U.S. focused. So if we could go to the first slide. What I'm showing you here, and I should say before I start this, I think as we'll discuss later on, generally we see the macro backdrop in 2026 as being favorable for commercial real estate, and I'll give you some of the reasons why. So here what I'm showing you is a snapshot of where I see the different property sectors in the U.S. kind of laying out today, the way we're viewing them. So on the left-hand side of the page, you can see sectors we're calling steady state. So these are ones where we're not seeing a lot of changes in fundamentals from quarter to quarter. Those towards the top of the slide are doing better. So sectors like medical office, manufactured housing, and open-air retail are really quite strong, and we don't see a lot of volatility there. Those at the bottom are, of course, underperforming. People are very familiar with the commercial office story in the US, and of course, life sciences has also been quite weak over the last few years as too much capital flooded the sector, it got overbuilt, etc. The next category is really interesting, and we could debate where the sectors might kind of fall on the spectrum of which are closer to recovery, but these are three sectors: apartments. We're also including build to rent, but not single-family rental within that category. Self-storage and industrial. These are sectors that did phenomenally well in kind of the early COVID period, 2021, 2022. Since then, they have softened considerably due to some combination of oversupply, such as in apartments and industrial, and softening demand, such as in self-storage and industrial. But we really do see indications that a recovery is coming soon, sometime in the next, say 3 to 8 quarters. And so we believe in these sectors long term, and we think there's going to be some good opportunity to jump back in and ride that market recovery. And then finally, on the right-hand side of the page, these are sectors that I kind of grouped together just because they have some interesting dynamics going on and they didn't really fit the other categories. So bottom right, I think we'll talk a bit later on. Student housing, a very hot sector over the last couple of years. We are much more cautious on it now, being very selective in the US about student housing. Data centers, very, very hot, of course, in all the headlines. Great fundamentals and demand story, but we have a lot of questions at Heitman about the capital markets story, and we might discuss that later. And then finally, top right, one of the top sectors, named by most real estate groups when they're giving their outlooks, senior housing. Amazing demand story, very little new supply coming online over the last several years. So we're very bullish there. So we could go to the next slide. And so I would say with a macroeconomic backdrop in the US that's pretty favorable, we think, in 2026. What I just described on that property snapshot as being generally pretty good fundamentals in most sectors. Those are two pieces of the outlook. And the third key piece is shown here, which is the supply outlook. So again, this is US focused. What we're showing you in the blue bars are new construction starts as a percentage of total inventory across each sector. The blue bars are where they peaked over the last few years. So we saw a lot of construction in many of these sectors. And then the orange bars show you where we were as of mid 2025. And we don't have the updated slide yet, but what I know based on the data is that the picture is generally the same with one interesting exception. But the overall point here is, as you can see, the starts in the orange bars have fallen considerably, averaging about 60% down from their peaks of the most recent cycle. So that is certainly going to help fundamentals. It's going to help owners of existing assets. And then the one exception I mentioned is student housing. So that orange bar as of year-end 2025 has actually crept up quite a bit. So that is one sector where we have not seen the supply pipeline overall empty out quite as much. And as I mentioned, we're being very selective because what happens in student housing is that certain markets get extremely overbuilt. Moving on to the next slide. This is a little bit of an outlook over the next few years through 2029. This is data coming from Green Street. It's their revenue growth forecast. So it's taking into account occupancy and rent growth across the various property types. You can see the overall average through 2029 annually is 3.5%. And if you look all the way to the left, this kind of underscores a key theme that we continue to sound at Heitman, which is that the alternative property sectors continue to be among the best performers. They have very strong historical performance going back the last 10 years or so. And then if you look to the left, you see the top 5 sectors expected to perform over the next few years: self-storage, senior housing, data centers, manufactured housing, and single-family rentals. So all alternative sectors. And then finally, I will wrap up and turn it over to Greg after I just give a few key themes for 2026 investments, which are right here. Overall, what we're saying, and we saw this play out last year, which was see through the noise, right? Everybody paused in the wake of Liberation Day, but what we saw was a strong enough macro backdrop, good property market fundamentals. And so we believe that this is the time to act if you have conviction in certain sectors or strategies. A couple high-level themes. We all know affordability is a major issue, and that continues to drive demand for a variety of types of rental housing, apartments, BTR, single-family rentals, even self-storage, which we might discuss later, because that actually becomes a cheap alternative for getting additional space when you're priced out of buying a newer, larger home. Second, aging of the population, driving demand for medical office and senior housing. Third, look beyond the sexy growth markets. And we've been saying this for a while, right? Everybody piled into the hot Sunbelt markets. They have great growth, but they are overbuilt now. And we have continued to see strong fundamentals in markets in the Midwest and the Northeast, especially in sectors like industrial and apartments. And then finally, with that construction pipeline emptying out, as I mentioned, we see opportunity to step in and perhaps do some new development in select sectors and select markets, whether it's on the debt side or perhaps with some kind of downside protection structure. So with that, I will turn it over to Greg. Thanks.
Yeah, and that was fascinating info on the perspective. And when I come in a moment to sort of our convictions, you can hear me okay. When it comes to our convictions, what sort of
Greg,
I
mean, are you having trouble hearing Greg as well? Yeah, your audio.
Right. That's just what we need, isn't it?
Wait, it's better
Let me
now.
just make sure I'm on the right speaker.
Sounding better
Okay,
right
let
now.
me. Is that better now?
Yes.
Yeah. Okay. Cool. I've moved a fraction closer, so you can see me in better full HD, and I'm a little closer to the computer. So let's see. Let's hope that works. Look, in terms of yeah, what we're thinking about in terms of the outlook, yeah, I'll compare and contrast a little bit about what we've just heard and what we see on a global basis at PGIM. But Brian, on the first slide I've got, I'd like to start just thinking about really almost the conditions for capital flows. And Brian, I know in your in your really strong outlook that you and your team put together, you were talking about Groundhog Day, and I know you're going to come on to this. And I guess the question is, are we getting into that point where we're going to see that big shift in, particularly in sentiment towards real estate? I think the thing, particularly for me and for our platform, that we're sort of waiting for is that kind of flood of capital coming back in. We've seen a bit of it on the credit side, but equity strategies, obviously, what's been going on in equity markets and how well they've done, has affected that story. And this chart sort of is sits in almost the opposite to there's one that's been doing the rounds I've seen a few times out on sort of social media and LinkedIn and stuff like that, where you've kind of got forward PE ratios in probably S&P 500, I guess, and like go forward returns from that point. And of course, it's sort of this downward sloping thing. The higher those in place PE ratios, the lower the go forward returns are. And it's a pretty tight relationship over time. There's a few issues about how it's constructed and a lot of debate around that. But this chart's effectively the opposite of that for real estate. There's not the concern about that. We've got low values, and we've got low values that should be driving stronger returns. So I think our sort of broader macro picture, setting inside geopolitics, which may come up in Q&A later, is a pretty good one for for reasonable recovery of the global economy. And really, so the chart, just to explain it briefly, what I've done is flipped over capital values in real terms, and I've calculated them relative to trend. So effectively, as you sort of that blue line is, the higher that goes, that means the lower values are compared to trend. And as you can see, track that through the cycle, and your sort of go forward returns from those points, the lower values are. I mean, it's a pretty obvious point, right? But it's like that's where we are right now. We've got low values, and we've got a prospect of returns doing pretty well. And I think that's where how I'm thinking about this is we've got a strong chance that returns are effectively going to outperform our sort of natural instinct to be quite consensus driven in terms of our economic forecasts, our rental growth forecasts. And actually, history tells us that we tend to under predict the strength of recoveries. So we're kind of, at the moment, we're all forecasting, 2.5%, 3% rental growth. major markets around the world. But we know that there's shortage of grade A space, and we know that that can turn very quickly. You know, we can see it now in pockets of, you know, London City office. You can see the competition for space suddenly roaring through and driving a rental growth story. It's still pretty select, but it's there. It's coming through. So we're pretty positive on, you know, on that outlook and how that's going to link in, and that sort of effectively we're coming off the back of a low building cycle, so we don't have a lot of grade A space, you know, in the market. And how, you know, it'd be interesting to see how that evolves. If we go on to the second slide, it's quite similar in spirit, I think, to the one that Emmy showed. Obviously, we've sort of grouped up the sector themes into kind of structural and tactical, and just given a little bit of a hint about, you know, where we see those playing out, you know, a little bit more stronger or weaker around the world. I think maybe one to sort of most on the watch list, and I think office, I think we agree that in North America, in the US particularly, it's a more challenging story, might be more of an office, you know, repositioning or repurposing story. But I think in Europe and certainly parts of Asia, Australia, Japan, where you're seeing some rental growth coming through, I think we're starting to see, you know, we're starting to form a much stronger conviction around, let's actually get back into office as a, you know, as a sort of, you know, as an alpha play to try and generate some returns in that market. And I think the other one for Europe and to some extent Asia as well is hospitality. For us in Europe, I mean, that's quite a big sort of modernization play. There's a lot of sort of smaller family-owned, you know, hotels that are out there that can be, you know, plugged into much more modern booking systems, and you can really drive some revenue growth. And again, I think that story may be not quite as clear and not as strong in the US. So I'd pick those out, and I think moving the other way, I think logistics at a sort of broader kind of larger scale kind of supply chain logistics is a little weaker, obviously with you know, global trade concerns, and also just the supply story that had come through. And then we still quite like that urban story and last mile and so on, serving consumer needs. And that's almost into that kind of idea of having living related infrastructure, which I think self-storage, I think, is a great shout, fitting in with that idea of providing the living spaces, but you also need to provide everything that goes with that: necessity retail, last mile logistics. I would sort of count in that as well for modern living. So that's pretty much sums it up from me. So Brian, I'll hand over to you, and look forward to debate in a few minutes.
Thanks, Greg. And you sort of gave it away a little bit about Groundhog Day, but you know, every year we sit down in about October and as a team and brainstorm about kind of what is our organizing principle and theme for the year. Last year, and I shared this on the equivalent of this webinar last year, was the dawn of a new real estate cycle. And so we themed it all around the morning and a kind of upbeat expected path for markets. But by the time of the webinar, we had started to really see some pretty significant volatility around the Liberation Day tariff proposals. So, you know, this year we actually thought that the dawn of a new real estate cycle would have been an appropriate theme, would be an appropriate theme for this time as well. But, you know, it was our theme last year. That was the problem. So we kind of honed in on the idea that it feels a little bit like Groundhog Day, this sort of cycle of optimism and disappointment. The charts on this page are, the top two are that Green Street PAF Rev PAM numbers that Emmy was also referring to. So think of it as just a combined indicator of market fundamentals, you know, occupancy times rents. And the bottom two are value indices. And what we have in that like purple color on each of these charts, US on the left, Europe, UK on the right, is expectations, forecasts earlier, right? You know, last year's forecast, 2 years ago forecast. It's really quite striking, particularly in the US, how the recovery has underperformed expectations and forecasts each time. You know, there was a call in the lower left chart you see for a troughing of values back in 2022, 23, and it took longer and values fell more. You know, the fundamentals after that, you know, post-COVID the post-COVID spike and a spurt of growth have really flattened out, and each time they're disappointed to the downside. So we feel like we're sort of stuck in this loop, but we see that we're now in the conditions are in place to break out of that. We talk about what it takes to break that loop. Our view is that it has to do with debt capital available and broadly available, conditions for improving fundamentals, and prices in line with bond markets and values in line with prices. And all three of those are more in place today than they were a year ago. So we really do think that we are going to break out of this Groundhog Day loop. For Bill Murray, he had to stop being a jerk to break out of his loop. And for real estate, it's got to do other things, but we think that is what's going to happen in 26. But our other themes are all framed around films. We try to have some fun with it. You've heard people say the phrase before. We've seen this movie before? Some kind of foreboding, statement based on past experience. And we would actually argue that we haven't seen quite this movie before. That there's a lot of things about this cycle that are going to be different, but we theme the rest of it after that, those around films. So we talk about the stagflation as the phantom menace. We haven't really seen the stag, and we haven't seen the inflation in the data. So despite several years of worries about the macroeconomy, inflation keeps coming down and moderating, and growth has been pretty resilient to all that uncertainty. So in addition to being the worst of the 9 major Star Wars movies, Phantom Menace is an apt descriptor of where we are in macro. We've already talked a bit about supply. Development is no field of dreams. You won't build it without you'll build it with, they will come, but you won't build it without higher rents. So supply is falling, and I'll show a chart on that. And rents have to grow in order to justify it again. Some markets are lost in translation. Obvious one there is Japan, which is doing a different thing where financial conditions are tightening rather than stable to loosening, which describes most markets. And then the theory of everything is how we set strategy in our global view. We've referred to fundamentals already and the variation of that globally. This slide is global vacancy rates by region. There are way too many squiggly lines on this chart to spend too much time on it. Normally I'll break it out one by one, but in the interest of time, I won't. I think a couple of key takeaways here. If you just look at those office lines, huge variation in the office story in the US, where vacancy is outside of the historical range and spiked up sharper than almost any movement on this chart, is not what you see in Europe, where it's within the historical range. And in Asia, where you see a big bifurcation between sort of Japan and Korea versus Australia, which has kind of gone through the whole work from home reckoning of North America. You also see this renewed cyclicality. Emmy referred to it in industrial globally in US apartments, where you've had vacancy get really tight and then go up the other way in the reaction to supply, but now that is stabilizing. And then you see sectors on here that have structural undersupply. European residential, extremely low and stable vacancy. Japan, multifamily, same thing. So really a variety of pockets of strength, stress, and stabilization. So here's that global supply chart. We see completions as a percentage of stock falling sharply and continuing to fall and below the historical level. The big exception to this, which isn't in these numbers, is data centers. We'll try and hit on that a little bit later. But this is going to be the driver of this is the foundation for recovering fundamentals. I know that development opportunities was highlighted on an earlier slide. Let's not let that cat out of the bag too much. There's certainly places where that supply is needed, but I think the market would really benefit from the rental growth that it will come from this choking off of new supply. And these, I'm not going to go really through this in detail. This is our table of our recommended strategies. For us, all of our process is centered around fair value, expected and required return. And then we have a couple of extra conviction calls that are a little more niche, where we think there's a special opportunity to execute, like European outlet centers, Japanese living and hospitality, et cetera. But I'll just leave you with the one observation is that every year I add more words to this chart, and at least for the last several years, every year my colleagues in the marketing and communications team told me that I need to be a better editor and cut some of them back. But I think it's really just indicative of how more sectors have repriced and come back into fair value space. So we're long past that sort of sheds and beds only vibe that we were for a few years after COVID. So it's not just indicative of my sort of inability to be a good editor. So I'm going to stop sharing the screen. Let's kind of set the stage there. I think we should kind of move into debate. We're already running a little bit behind where I thought we would be. I think a key question here is the steepness of the recovery. You know, people talk about, you know, different letters: V-shaped recovery, U-shaped recovery. K-shaped is the current meme to describe where we are in this recovery. I've had a little bit of a debate about how optimistic we are. I think that our view is that the recovery will be relatively more gradual, because we're not in anything like the post-GFC highly stimulative interest rate environment. But we had some disagreement on the call. So maybe I'll start with Greg. I thought you were have a little more bullish perspective on the shape. Maybe you can propose a letter that you think best describes it.
I'm terrible on letters, but yeah. Look, I think I summarized this a little bit in my comments there, and yeah, I think look, really where we are is I think we see a bit of optimism around, particularly around sort of the productivity aspect of things. I think you're starting to see that come through in the numbers. We've got a lot of investment-driven growth at the moment, where we are, you know, to the extent we are seeing growth in the global economy, and I think yeah, we're in this sort of phase where labour markets are a bit softer. But you know, companies are obviously rebuilding margins, and I'm quite optimistic about that sort of ability to pay rents going forwards, and hopefully that will usher in, you know, a stronger recovery with more employment growth and stuff to come. So look, I think from our side, I mean, obviously we've got there's a little bit of selectivity here. We are a little bit concerned about sort of affordability. I think affordability, Emmy mentioned up front as being one of the key points. I think from our perspective, affordability for things like logistics has become a bit stretched. But when we look at office, we look at retail, and to some extent apartments and rental housing, just because of how strong income growth has been globally, we see affordability is pretty good. So coming back to that point I made earlier, we tend to underpredict the recovery. You know, this could be a little bit selective. This is not a super fast growing global economic, like, massive expansion story, but I think we could see some upside risks on the economic side. And I think where that demand comes through, it really is coming up against not very much supply. So the affordability story in office and retail, you know, particularly in Europe, where we're seeing this very clearly, and parts of Asia as well, is obviously because you've lost a lot of stock in those sectors. You know, supplies come out of the market, so net additions to stock have been quite weak. So the amount of economic activity being generated on top of, you know, a shrinking amount of real estate is actually starting to look quite good in terms of, well, can we, you know, will we be able to generate more rental growth in these sectors? So look, I'm kind of, that's the sort of, you know, working through why I've got some bullishness, and quite frankly, you know, when we forecast, economic forecasts are always going to err towards potential growth, but the reality is, you know, interest rates probably get cut too far. You know, some growth drivers come through. There's going to be some outperformance of that. You know, you'll have you've got a tailwind from past rate cuts coming through and pushing growth forward. So I think the chances of you know, geopolitics and other, you know, these big macro risks aside, you know, I think we're looking at a potentially stronger period, and that's just coming up against this very, very low supply world. And I think, Brian, you picked that out, and your chart showed that really well in terms of it's not going to be a lot. So, and it's going to take time to build. I mean, you know, as you said, rents can rise and it'll stimulate building, but there's a lag there.
So something starting to look more V-shaped, maybe, if you want to go with a letter.
But it's kind of like it's had that thing along the bottom, hasn't it? And now it's
an L with half of a V attached to it. Emmy, what's your take, and is there a letter?
Yeah, I'll have to think about a letter, but I would say, I think, Brian, you and I are probably a little more aligned on this view, being a little more cautious. You know, I just think, again, we got burned just like everyone else. We went into last year really bullish, and we thought, again, property markets did well, but we thought capital markets were really going to rebound, and they really did not. So I'm trying to be a bit measured, but I think secretly I am crossing my fingers, kind of hoping. Again, I do think there's some upside to this recovery. I do think, you know, there are a lot of investors on the sidelines. There's a lot of capital waiting to be deployed. And you've got the addition of these new sources of capital, right, from the retail and high net worth channels. And so, having all of that start to funnel back into real commercial real estate would really amp up the pace. But that is, not our base case scenario.
And right, I think part of that capital markets delayed recovery is partly because you have so many assets tied up in closed-ended structures that are at the end of the life, and it's just not being returned. The strength of the stock market has allowed that denominator effect problem to not be a problem, at least for now. But we'll see where things go with the valuations of some of the big names that are driving the stock market indices. But that was a big factor. I think another one holding back the U.S. capital markets is just that you don't really have, in most transactions, year one positive leverage. You have positive leverage in many cases on an IRR basis over a hold. But you have to be really confident, which we are, in the recovery and the longer term view on growth. But that brings me to an interesting second comparison, which is global comparisons. Okay, United States versus Europe. Maybe we can put Asia into that. Europe, you do have widespread positive leverage today, kind of year one positive leverage. Interest rates have come down sooner and sharper. And so that has, I think, returned animal spirits to the European market. We had a nice debate as we were preparing for this about whether we're more bullish on the US or Europe. Greg, I think you're structurally biased given that your business card says Europe on it, but what is the PGIM take on that?
Yeah, look, I think you're absolutely right in terms of like the leverage story is one of the attractive points about Europe. Low borrowing rates, you can make business plans work. The low supply story is probably more acute here, as you guys both mentioned in the US, that there has been more of a supply story around key property types in recent years in the US, and really not much in Europe has gone through that, perhaps with the exception of some logistics and distribution markets. So I think it's a tricky one because I think overall our forecasts are still pretty strong for the US. I think we like the longer term growth drivers and how that feeds through into real estate fundamentals and where returns will land. So I think my positivity is more sort of Europe and obviously parts of Asia as well, sort of closing the gap a bit, and then really what characteristics can the European market offer? And I think that sort of there is a little bit of a sort of slightly more defensiveness around certain aspects of location and certain property types that Europe offers, slightly low volatility profile in places. Not all markets. For sure, but you've got a good mix of, there are some growth stories around as well, with particularly Southern Europe, Spain as a standout, where there's a sort of much more of a US style growth story with both job creation, immigration, driving kind of overall demand. I think the UK sort of is an interesting one because that's the strongest sort of overall real estate market in terms of institutional penetration. But that's where I think, Brian, your story about the leverage is being a bit more fiercely kind of debated because domestic interest rates still quite high. Look, I think from my perspective on that, we've obviously had a lot of periods in the past where not all within my career lifespan, but clearly looking at the data, where this kind of thing used to hold. You had relatively low ingoing yields, may have had quite high market interest rates. Certainly in the 80s, early 90s, this was quite often a feature, and you had to rely on that pass through from inflation into rents. So obviously, in the old days, back then you had stronger leases, particularly in Europe, longer leases, stronger covenants that kind of gave you as an investor a little bit more protection. I think there is that challenge around the mismatch is maybe a little bit amplified just because of lease lengths being a little bit shorter these days. So the mismatch is there, and of course, look, you can also get in on the credit side here as well and take a slightly more protected position and still get that capital working in some of these markets, whether that's with profit participation or on the equity side. So look, I'm pretty bullish on Europe, but look, overall, I think we've still got a strong view on the US outlook, like you guys as well.
I mean, where are you on Europe versus US versus Asia potentially?
Yeah, so I am also a little bit biased, right? Because we're pretty US focused, but we do, of course, do business in Europe and Asia as well. And I would say we are most bullish, and I am most bullish on the U.S. We're kind of mixed and selective in Asia Pacific, and then while we really like the European alternatives story quite a bit, and living sectors, of course, we're just not quite as gung ho, I'd say, in Europe. So, I would point to, of course, just the dynamism of right the U.S. economy, the stronger growth potential there compared to Europe. I think there's quite a bit of upside to the economic outlook in the U.S., especially this year. The Trump policy mix in 2026 is going to be much more pro-growth than it was in 2025, right, when we had a focus on tariffs and immigration. Although that's continuing right now, it's more about tax cuts and deregulation and things that are stimulating growth. Another point, which I think you both brought up, which is interesting, is that while the negative leverage issue is still around, right, it's definitely improving, right? So you've got lenders are completely back in the market, as you know, right? All types, all property types, all markets, and spreads are coming down. In addition to that, you've got the outlook for base rates to come down this year as well. So I think that's starting to be less of an issue that we see. And then, finally, I think what I've noticed, I think last year there were a lot of predictions about, in the wake of Liberation Day, that there would be some sort of, massive shift in capital flows to the U.S. And, I think while we see that on the margins for sure, right, there's certainly no kind of wholesale, move that we're seeing from international investors in terms of continuing to invest in the U.S. And I think, one other thing I always like to point to is just the breadth of the investable universe in the US, right, is unmatched. So, when I go to Australia, I always tell them to put it in context. I think there are 4 or 5 cities in Australia that have populations of 1 million people or more, right? But there are about 50 plus of them in the US, first of all. So you just have these markets serving massive amounts of people. And we have more developed alternative and niche sectors here, right? So you're getting really interesting investment opportunities now in industrial outdoor storage and boat and RV storage, right? And all types of rental housing. So that all to me adds up to a pretty attractive opportunity set.
Great. So we're going to hit on, we're going to move to the rapid fire, and we'll do this quick. We want to make sure we allow time for Q&A. Rules of the road are changing, a sentence or two on a sector or a view. We'll start with data centers. I will try and see if I'm capable of this, to do it 2 sentences. Super chunky assets, not a lot of proven exit liquidity yet with the size and scale of those assets. So we prefer a public market execution. Long-term view on disruption to the underlying technology. Most real estate is about space. This is about something that's really heavily mediated by technological innovation, because your users care about compute, not space. So maybe more cautious than the consensus, and this short-term view, which is rosy. Greg?
Yeah, look, I think we've got a slightly more nuanced view. I think obviously with the sort of the AI push has created a lot more risk around those sort of higher latency locations, which are going to be feeding the AI. So it's creating opportunity because new locations come in that don't need to be quite as close to population centers, but the risk of oversupply in those markets has also gone up, or really because we are just a long way from knowing precisely how much capacity we need. On the other side, when you get closer to population centers, around the world, the demand story is just incredibly strong, and the supply story is not very strong. And I think those two things still create we're going to be more careful in this sector than maybe 2 years ago when it was pretty much just a universal buy. But yeah, we're still pretty bullish on being able to execute and on strategies, particularly ones that are maybe linked to financial centers or close in for consumers who want to be gaming or whatever when you need to be close to those population centers. So yeah, we're still good on the sector.
I mean,
similar to you, Brian, more cautious than consensus. And for us, it's really about the obsolescence risk and the questions around the exit, as you mentioned. So we've seen, for instance, a lot of surveys showing that 70% or so of institutional investors want to invest in data center development, right, opportunistically right now, but only 6% want to buy a stabilized, completed data center asset. So, who's buying that? And yeah, that is a big question for us.
Okay, we'll do maybe one more of these. Private real estate credit. I think all three of us work for firms with a debt platform. Private, my take is private real estate credit is not private credit. We rode on the coattails of a fundraising boom for private credit over the last few years. We're talking about lending to corporates with a whole range of degrees of transparency and credit risk profiles. Real estate loans are secured by income producing assets. And so we need to shift the language around this sector from riding the coattails of something that's now perhaps arguably become a structural economic risk, private credit towards the broader economy, versus something we don't see that in real estate. So we're bullish, and we think there's lots of opportunities in different parts of the capital stack to be a lender. Greg?
Yeah, so I guess you're saying private real estate credit brackets secured versus unsecured. No, look, I mean, we certainly see it. I think we're looking. I mean, the reason we're looking at things together in the private credit world is really just that attraction of capital into real estate and trying to line up with how our investors are actually thinking about this. And so, to the extent that many investors do group these things, a loan secured against something, we're grouped together with loans secured against other things. We are lining up on that. So but I agree completely that the sort of mortgage aspect is quite different to providing lending into other parts of the market. And look, the great thing about credit at the moment, you can get access to product pretty quickly through refinancings. As development comes back, there'll be some good returns there. You can get back into sectors where you've still got a bit more of a risk, a larger sort of distribution around your point forecast. So that could be if you're worried about office, there could be a structured play either on the senior end or more junior debt where there might be profit participation as well, but you can sort of take a little bit of that risk off the table while still getting into that market. So I think it offers again, returns are pretty good versus equity as well. So we'd still see credit this year as being a important part of the investment mix.
Yeah, I would add similarly, we are positive on it. I will say one thing I've noticed recently is that the opportunities we're seeing in our high yielding debt space are they're getting more challenging. It's getting more challenging to find the same kind of risk return profile that we were finding over the last couple of years. So we're having to think about how much further is prudent to go up the risk spectrum, right, and still get those kind of low to mid teens returns. So just a note of caution there.
Okay, we are going to squeeze in one more rapid fire round. Typically, as researchers, I don't know if our track record of being faster in the lightning round is really bearing fruit. We always have on the one hand, on the other hand, and we want to portray a nuanced view. But let's take office. Okay, U.S. offices, global offices. I'll try and be really fast. I'm going to take this challenge as a researcher to not have too much nuance. We think that office is all about CapEx and keeping it leased and keeping it modern. And we see budding risk of overpricing already at the high end of U.S. offices, as these assets have done well, but are already assumed in underwritings to be permanently perfect, which is just not how offices work. So we're quite cautious. Greg, pick up the challenge of succinct lightning round style.
Yeah, so much. Okay, so product. Look, for us, I'm really interested in the ability to drive rental growth on the back of productivity. Productivity, it means the ability to pay higher rents, keeping other costs fixed, growing revenues, and I think that can feed into rental growth. And we are seeing that, but we're seeing it. And this is different to the last cycle where it's all about employment and just any old space. We're seeing it in the best quality space. So while that's a cliche, invest in the best quality assets, last cycle, that didn't help you that much. This cycle, last few years going forwards, it's got to be the best assets. We're seeing a lot of rental growth, London, Paris, in Asia, we're seeing it in Sydney, seeing it even coming through in parts of Tokyo as well. So, yeah, that story, but leaning into that kind of productivity growth trend, I think, really good for me. Completely understanding the US, slightly different dynamics, legacy vacancy, etc.
I mean, where are you
Yeah, similarly cautious, but I am starting to hear little notes of positivity from the people on my team who spend, all day thinking about the office sector. So that's kind of interesting, but I don't know that we've quite identified exactly where that opportunity is, because to your point, Brian, I agree, it does not appear to be there in the high end segment. And there are so many questions around the, kind of class B and lesser A quality space. So we're not ready to jump back in yet, but we have been on high alert, kind of waiting to see, when those opportunities start to emerge.
Great. So Trisha, let's bring you into the conversation. You've been monitoring the Q&A. There's a lot of sectors we didn't really get a chance to go to. Trisha, where should we start?
Sure. Thank you first of all, thank you, Brian, Emmy, and Greg for that really, very kind of interesting discussion, and especially the more specific notes around the various sectors. Kind of one follow-up question around the data center opportunity. Emmy, you had mentioned that, there's obsolescence risk. You had mentioned the stat about 70% of investors want to invest in data centers, but development only 6% want to buy stabilized asset. Is there a value add play in data centers? And if so, what does that mean? Because it sounds like we have this kind of development opportunistic on one side, more core stabilized. Is there that middle ground that you see a lot of, in other sectors, you have that value add? I don't know what that looks like in data centers.
Greg,
Yeah, maybe Greg or Brian can speak to that, because we haven't found it either. So you guys might have, yeah.
I think this is a great question for Greg, because PGIM's quite active in this space.
It's really, I mean, our activity is much more based on a sort of buy and hold strategy. So, like, I hadn't heard that stat before, I think, but I do sort of recognize it, that it's data centers are sort of an odd fit, aren't they, between classic real estate, and do they fit into a sort of core or core plus real estate fund, or do they slot into an infrastructure fund, and on what angle? So, yeah, look, I think Brian, you mentioned sort of public listed market exits. I mean, that could be one route. The credit angle, and just sort of heavily remortgaging these assets, or some sort of tenant credit lease type of arrangement. I mean, there's obviously routes to kind of recapitalize and exit. But yeah, look, I think it is a really good point. I mean, a lot of our investment is done on a long-term, develop, buy, hold basis. So yeah, for a fund, I think, it's still, where you're looking to flip and turn those profits, that's going to be a challenge.
The thing about data centers that is so remarkable in driving the scarcity right now, that it means that leads to these high developer profits, is the scarcity of power. Every data center person will tell you that they measure it. They don't measure it in square feet or square meters. They measure it it was megawatts, and now it's gigawatts. But that is very different than other real estate sectors, not just because it's a different unit of measurement that's measuring something else. It's also not a unit of measurement that fundamentally, at the end of the day, the end users actually care about. They care about, like, computational outcomes and results and tokens and compute, not the power, although that's the scarcity now, which is why it's being measured that way. That's different than the rest of real estate. I mean, to bring it back to my movie theme, unless it was Honey, I Shrunk the Kid, I'm not gonna be able to live in a smaller, with a 3-foot bed instead of a 6'6" bed. So the But I think that there's a chance for Honey, I Shrunk the Kid as it relates to the power needs to do certain computational outcomes in AI and other uses of the data centers in the long run. So that's kind of a driver of caution for me fundamentally.
Great, thanks for that. Emmy, did you have a note on that? Oh, no. Okay.
Well, I was just going to say, is it worth us just because I've mentioned it a couple of times that the geopolitics angle of what we're sort of seeing. I mean, I'd be very interested because I spent a little bit of time yesterday from a European perspective thinking about this topic in another forum. But yeah, Brian and Emmy, I'd be very interested to hear from you guys on how you're seeing some of the current developments without wading into politics, but more just the general kind of the mood music of what's going on and how that's affecting. So I think as you said, like last year, the liquidity story is starting to look very good. And then early in the year, the tariffs and it really derailed sentiment. I mean, do you think we're more resilient to sentiment this year? And yeah, how do you sort of see all these things playing out? I don't mind coming back on sort of some European stuff at the end.
Hey, Greg, are you asking me to reveal our super top secret casinos and hotel development strategy in Greenland? I think it's pretty remarkable that the markets have proven this resilient to things that many of which wouldn't have been even really contemplated as a possibility a few years ago. So there's a kind of almost like psychological ability to adapt to a new normal, and you usually see a strong correlation between geopolitical uncertainty and a negative correlation between that uncertainty and investment in the economy and investment in real estate as well. I think that where it really points to is more volatility in interest rates and probably stickier, higher interest rates, with this putting in some risk premiums in the longer end of the curve. Have more volatility and higher inflation probably than we've experienced in most of my career. And real estate isn't necessarily a losing asset class from that. In fact, it's probably relatively well positioned as a real asset. So that's how I look at it. But a lot of these things are both beyond beyond my fundamental expertise. And even if you had a crystal ball and know exactly how certain geopolitical things would play out, it's hard to know how that would translate or not into real estate outcomes. What do you think, Emmy? You're going to tell us your secret Greenland strategy?
Yes. No, I agree. So I would say we, right after Liberation Day last year, right, we were, of course, inundated with questions from investors, right? People were very concerned. Our kind of house view was, we know it's tough and these are important issues to think through, but again, see through the noise, right? Because some of it is just noise, right? There's headlines changing from day to day. While that volatility does matter, the way I've seen it play out, most strikingly is, again, just in the sentiment, the investor sentiment, right? As I said, the fundamentals have stayed pretty steady. That being said, right, there are some things we've been gleaning from this, such as this shift in trade patterns that we're seeing, that we believe to have some lasting effects. And so, while in the U.S., for instance, the West Coast industrial port markets, right, have been the absolute winners for the last 2 decades, that we see changing, right? So that's a real shift that we're taking out of this, but not every headline that we see and every policy that comes out from President Trump is going to change our long-term strategy. And you can take something like single-family rentals, right, and the recent hubbub around that. But again, when you dig into the real story, you see that it's completely ridiculous, right? Because institutional owners own a tiny percentage of single-family rentals, for instance, and so we don't actually foresee that necessarily having a huge impact on that sector long term.
And the way that institutional investors have been participating in that market for several years at least has been in creating stock, not buying existing homes. So that's participating in increasing the housing stock.
Yeah.
Trisha, what else is coming in the Q&A?
Yeah, so yeah, we have a question around, what potential long-term tailwinds to all asset classes due to AI's, impact on employment and access to power. So, how does AI and affect, obviously, people have talked about AI data centers, but AI and, kind of maybe some of the more traditional or even the alternative asset classes.
I'll be quick and start with that, a take on that. I referenced the K-shaped economy earlier. That's this sort of meme that's going around LinkedIn. Has a lot of truth to it, has a lot of flaws in it. I'd say one thing that's not happening right now is AI is not currently destroying jobs. A lot of people see the weak job market as indication that these people are being replaced with AI. I see the weak current job market, which only shows up on the hiring side, by the way. Jobs aren't really being destroyed, as indication of overhiring in the post-COVID recovery. Maybe companies dealing with tightened profitability ratios around having to pay tariffs. And if you're a CEO and you're a listed company, are you going to tell Wall Street that you're not hiring the way you used to because you messed up and hired too many people 3 years ago? Or are you going to tell them it's because you're leveraging AI and having wonderful gains and you're super productive? And, by the way, you're no longer in the X business anymore. You're in the AI business. You're going to tell that story. So I think long-term, there's lots of questions here, but we're not seeing it right now. And, I think the actual use cases today and the value created by AI today ranges from really cool and really great to, something that's not suitable for public statement on a webinar like this. BS.
I think from my perspective, I think I'm relatively bullish on the sort of AI side, or at least productivity side. As you said, there's cost cutting at the moment. There's efficiency gains, some of which is AI investment or tech investment related, and other is just working existing resources harder. But the one thing that does happen, and I think this is the pass through to other sectors, is that does set the ground for stronger wage growth than you otherwise would have had. If you've got unit labor costs kind of stabilizing or coming down, you can drive wages a little bit higher without having to put prices up and put off your customers. So I'm relatively bullish that obviously has a positive impact certainly on living markets, living sector, where that translates into better affordability and potentially better rental growth on the ownership side. And also potentially to the retail market as well. So I'm quite positive that actually, and Brian, you're absolutely right, it's not a job destruction story. There's probably some near-term pain and headwinds in the labour market, but longer term, as people get redeployed, should become a positive.
Yeah, I broadly agree. So, right, I mean, you just look back at any other technological, right, revolution, and there's a lot of disruption at first. There's often, a bubble that forms around it initially, but over the long term, again, things kind of resettle. You do have some people that are maybe mismatched in terms of skill set with the new jobs, but you have many new types of jobs created. I think as we've seen so far, right, its real utility for the most part is in making people more productive in their existing roles, right, rather than replacing them entirely. And then, of course, for real estate, there's a lot of potential upside in terms of the property operations, right, and the things that AI can do to operate your properties more efficiently, and that's all going to help your bottom line. And that's across, most property sectors.
Great. I think we're almost to time, but I think of one last question for the panelists. You guys, I know, have been around, you guys have been talking to various clients and LPs. Anything come up in those conversations from LPs, something that they're interested in that you guys weren't necessarily thinking about, or something that was a little contrarian? I'm just curious as to kind of how those conversations with your clients and LPs are kind of, maybe turning up new ideas or not.
takers?
I'm trying to think.
Or it might be consensus, everyone's kind of generally
Yeah.
on the same page.
I think the returns level, I think, is a really interesting returns level is a really interesting aspect of this, of what returns do people need. I think my worry is there's a little bit of a mismatch between certain pockets of capital that want to come in and the returns that can be generated. Now, I'm quite bullish in the next couple of years, as I've said, in terms of short-term returns and maybe having a slightly stronger period, but that doesn't mean that's like you're over a cycle, very high returns, 18, 20% IRRs, whatever it might be. And I think for me, we've got to get back to a world where real estate is still a relatively utility-like product. You can drive some rental growth, but it's not a sort of leverage days of low interest rates have gone. So I think making sure that investors, it's less about the strategy and more about making sure everyone's on the same page about what real estate can deliver and can deliver for your portfolio.
I've got one. I agree with that, Greg, and I'm hearing that as well. Is increasing openness to hiring generalists who can pivot their strategy based on rapid shifts in value. It used to just be, we don't want a generalist who's allocating between sectors. We want to hire the expert in that sector. But if you, by the way, if you give a capital commitment, a couple $100 million to a specialist, and you see apartment markets go from super strong to pretty weak, which they did, especially in the Sun Belt, they're going to keep deploying if they can, because that's their mandate. And we've seen rapid shifts in value of the sort of, COVID was like dropping a bowling ball into a bathtub, and the bathwater is still sloshing around from that. That's this supply boom and then bust. And that shifts value quickly. So I think there's value in being not only operationally smart, which is obviously super important, but allocationally smart. And that's why we do fair value.
Yeah, and I'll just add on to that. I think to Brian's point, the growing interest, right, in, again, these alternative sectors, niche subtypes, right? You want to get into industrial outdoor storage, right? You want to get into marinas, right? You want to get into one of these emerging asset types. Again, yeah, you're going to go to a generalist and a group that knows how to get into those emerging sectors, right? When you don't have all of the institutional data and history there, and how do you evaluate them prudently and find the opportunities?
Well, as you said, Trisha, we're at time, right? So thank you, Trisha, for moderating the Q&A. Greg, thanks for joining us and hanging out with the Stanford crowd. And Emmy, always great as usual to talk about the markets and the outlooks with you, as we've been doing our whole careers.
Yeah, thank you.
So thanks everyone for joining.
Yeah, thanks for having me. Thanks everyone.
Thanks.
Bye.
Bye.